Adventures of Pipeman on W4CY Radio.
This is the Pipeman here on the Adventures of Pipeman W4CY Radio with our Positively Pipeman segment. And this is where we talk about some powerful business strategies from Michael Barbarita, our resident expert. And this week, we're going to talk about preparing for exit. That is a very important subject for anybody that's a business owner, because you should always have an exit strategy. And Michael, why don't you tell them why and how to do it?
That's right. Well, because someday you will be separated from your business. The question is, will it be a great day? And so a lot of baby boomers right now, which is a large part of the population, are selling their business. So from a demographic standpoint, a lot of people are looking for the exit, and the exit isn't something. It's not like selling a house where you just put a for sale sign on it, or selling some type of asset that you have. It's totally different. It involves, and in my description, I talk about how you need to prepare at least 2 years. It's probably closer to 3 would probably be the optimum amount of time if you're thinking about selling. It's not like you can't think about selling on January 1st, 2026 and try to sell the business at the best price. You can, but at the best price and an opportunity in 2020, and try to sell it in 2026. It's just not the way to go about doing it.
Right.
Right. So some of the things that you have to do is, first of all, you have to keep the company focused on growth. Because you do want to, if you're going to be selling in the next couple of years, you do want to maximize your profit, because that's why people buy a business. They buy a business for 2 things. Number one, so the business they'll pay more money for a business that is a business and not a job. Very important designation there that I'll get to in a moment. But and they will pay. They want to pay for opportunity. They don't want to buy a stagnant business. They want to buy a growing business. So you have to constantly keep the eye on growth. Also, you have to reduce the reliance on you. The more you reduce the reliance on you, the more valuable the business is. Why? Because people don't want to buy jobs; they want to buy businesses. And so,
right.
if the buyer foresees that they have to do a lot of work, that they have to work 80 hours a week like you do, that's a problem.
Yeah.
Because they're buying a job. That doesn't work. So some people would do that, but you get a low nickel, you get a low price when that happens. It's just that the EBITDA multiple goes down.
Mm-hmm.
You got to make sure your accounting records are in shape. Because if a buyer goes in there and your accounting records are a mess, they're just going to walk away, and they're not even going to give you remotely give you an opportunity to make an offer.
Why would they?
Right. Right. It's got to be in line. The other thing is if you're a seller, you have to understand your tax ramifications of the sale, because that one can blow you right out of the water depending upon the structure. One of the worst structures to sell is a C corporation, because there's a double taxation associated with that.
Yeah.
Okay. Once to the company, they get taxed, and then you want to take the money out of the company and put it in your pocket, it gets taxed again. So you have to really convert that C corporation to a sub S, and that can cost you some money for sure, not just in preparation, but also more importantly there's this thing called a built-in gains tax, which is a nightmare. But it's better to convert and pay that built-in gains tax than not convert and pay the double tax when you sell. So if you're a C corporation, get out of it. But in the meantime, understand the tax ramifications. You've got to understand all your estate planning ramifications. Okay, you want to make sure that if there is a sale, and if you're not around, You want to make sure it goes into the right hands. Or if there is a sale and you are around, you're now going to be hopefully dealing with a pile of money that you have to, properly estate plan for. So that's another important consideration. Strategic buyers are always willing to pay more, even though they don't let on that they will. Okay, so a strategic buyer is somebody who is in the same business or serves similar customers than you do. They already have the overhead base, and all they're doing is piling your sales onto their overhead base. So a lot of that profit falls to the bottom line. They're willing to pay more. They won't let on that they are, but they are. So looking for strategic buyers is a way to maximize the purchase price. You should have a valuation done on the company. Not that, and by the way, most valuations that are done are definitely overstate the price, in my opinion, but it's good to have because it's an overstated price, and it's good to get an overstated price. So usually a valuation is something that you should do during that 2 to 3 year period. You got to find a good business attorney. Without a good business attorney, somebody who understands how to negotiate, somebody who understands business and law, because no matter what the case is, there's usually a couple of crisis points in like every deal. And you need a lawyer who understands the business ramifications so they can negotiate on your behalf. Because you don't want to sit there and negotiate all the, certainly the major terms are negotiated, but all the Mickey Mouse terms that can actually ruin a deal, those are best served between the attorneys. And if your attorney understands the business concepts, they're going to have a leg up on the other attorney during that type of negotiation. So that's critical as well. You got to understand, you got to decide what your role is going to be. Some sellers stay with the company in this capacity that they were in when they were the owner. So that's the other component. What role do you want to play? Some are just consultants to the business, and they get paid for that, by the way. Don't blow that one. If you're a consultant to the business, you should get paid for that. And by the way, that's earned income versus capital gain on the business, and that might be taxed at a lower rate. So you might be able to allocate purchase price toward a consulting agreement, which is something that you might not do any work on, but you might answer questions from time to time, and you're probably willing to do that at a price, and you should be. But you can allocate purchase price to that. You can also allocate purchase price if you own the building. You can allocate some purchase price to increase rent. That helps because the building will help. The depreciation on the building will help offset some of that extra income. So it's just another way to manage it. When I sold my businesses too, I used to allocate price toward telephone numbers and different types of intangible assets. Now these, at the time when I did it, it was a 5-year write-off. Now it's 15, so it's not as much of an advantage. But the more assets that you could allocate purchase price to, usually the better you are tax-wise. But you should consult your tax attorney or your tax person on that. So there's just a bunch of things, and my list is even longer, but there's just a lot of things that you need to do to prepare for a sale. It's not one of these things where you just put a sign out or, just ask a couple of people if they want to buy. It just doesn't work like that.
No, it doesn't.
Right. And if you want to use a broker, there's a lot of reputable brokers out there, but you've got to be careful because there's brokers who really don't understand business. And because there's no license to be a business broker per se. There really isn't.
And they love to spam you.
That's right. They do. Yeah, that's another thing. But those are the main points in terms of if you're going to be selling a business, you got to prepare for it. And like I said, there's a lot more points you have to think about as well. But those are the critical ones that I think if you understand those types of things and plan ahead for those types of things, you're going to be in good shape.
Very cool. And yeah, it is very important. I think it's very important that somebody consult with an expert on something like this so that they don't make any mistakes. And that's where I think they need to reach out to you, Michael, and Next Step CFO. How can they reach out to you and get more information on how to do a proper exit strategy or anything else having to do with any powerful business strategies?
Well, they could go to nextstepcfo.net. They could go to the contact page and ask any question they'd like, but they also could take advantage of our AI business assessment diagnostic, which is it's an AI diagnostic. It takes less than 10 minutes, and it'll find hidden revenue in your business. And it'll identify 3 key strategies as it relates to your business through the AI questions that are asked. And it'll also explain how to go about implementing those strategies, and it's free. And the beautiful thing about the AI assessment, everybody says, "Oh, AI." Well, the beautiful thing about it is there's no advisor with you or anything like that. And there's no judgment. You could be right, honest engine with it, and the results will reflect your honest answers, and you'll find hidden revenue in your business. So it's a great opportunity. It's the orange button on the right. It says find hidden revenue in less than 10 minutes, and that's the diagnostic.
Nice. Well, thanks once again for your words of wisdom, Michael, and we'll look forward to talking with you next week about cash management.
Excellent. Thank you, Steve.
That's an important one, too.
There you go.
Thank you for listening to the Adventures of Pipeman on W4CY Radio.